Oppenheimer Asset Management's John Stoltzfus is here. John, we often see this reaction to a tariff headline. If it's 15 to 20% on the EU will wait for more detail on that. Do you want to kind of put that into context for us in terms of how important you think that headline is?
Yeah, Kelly, we've been saying for quite a while now that we think that the market's biggest concern is the tariffs, because the end point on the tariffs is still unknown. Negotiations either in progress or sort of out there on the distant horizon in case of some others. And the market looks at it as to what will be the effect within sectors, within market capitalizations, and even within style, growth versus value. And that's what the worry is, because on the other hand, we've seen in terms of revenue and earnings growth, that's going fine. The Fed has done a good job in slowing the pace of inflation. And we've got the consumer remarkably resilient relative to all the, we had 11 hikes and then 3 cuts and over 9 pauses at this point. So where we are, no recession, we're doing good on that hand. It's the tariffs that are the concerning point.
Right. So when you say the concerning point, a lot of people, try to extrapolate out to the end outcome. The market's been shrugging off the headlines in large part lately. I mean, the EU is a biggie, though.
I think most certainly because the major trade partner. And what we've got to figure here is that until we get some kind of agreement that looks livable, this volatility remains an issue. And I think that the problem is that, Europe is now is working, considering other partners in terms of trade to offset what it might lose with the U.S. But I think that ultimately the longer-term relationship that exists between the region and our country we'll see something that will arrive that will be livable for both the consumer, for both the importer, or the exporter, rather, and for the importer. It can be worked out, but at a lower rate than what we're hearing.
15% free cash flow.
This touches on a little chat we had with Tim Seymour yesterday, John, where he said, look, this U.S. exceptionalism narrative got way overblown. You go back to January, and it was all about how big we were in terms of global market cap, how well the market had done, where were the European innovators, so on and so forth. Of course, now international markets have kind of trounced us. But you say you believe U.S. exceptionalism remains very much intact.
Oh, absolutely. We really feel that it does remain intact, and it has to do with innovation and technology. The run that we see when we look around the world, and we've been global investors for just about 40 years at this point, it is that it was valuation, which was extremely low in comparison to the U.S., which is inevitably helped the international markets. And then with expectations that there would be some kind of agreement in terms of all these tariffs, it's not the end of globalization. The rest of the world feeds into this. But we believe that the U.S., particularly perhaps as Bill Gross used to say, the cleanest dirty shirt in a hamper of dirty shirts, if all countries are a hamper of dirty shirts, exceptionalism remains a brand of the U.S. when you consider the effects of technology.
Yeah.
And around the world, society, business, and consumers deeply have technology deeply embedded in their lives.